Hello, everyone. Thank you so much for joining us for today's webinar. This is our quarterly webinar where we do a review of the voluntary carbon market. Today, we will be reviewing the first 2 quarters of the year, and we will be doing a spotlight on corporate carbon claims. Our speakers include Guy Turner, our CEO and founder, myself, Tanya Vora, marketing associate. I will be hosting today's webinar. Lucian Georgeson, our head of policy, Delphine Stringer, analyst, Yelena Peshkatari, senior analyst, and Gregoire Mazar, lead analyst. Just before we begin, I would like to go over some house rules. The structure of the webinar is we will do a quick presentation to begin with, and then there will be a short Q&A at the end. All attendees are automatically muted. Should you have any questions throughout this presentation, please use the Q&A function at the bottom of your Zoom window. We will be monitoring this throughout the webinar and will answer your questions during the Q&A section at the end. The slides from today's webinar, as well as a recording of the webinar, will be published on our website by the end of the week, and please feel free to share this with your colleagues. The agenda for today's presentation is as follows. To begin with, we will cover some key developments in the second quarter of this year. Then we will go on to do a spotlight on corporate carbon claims. We will then cover key things to look out for in the second half of the year. We'll then do our traditional audience poll, where we will give you all the floor and ask you what you think the price of certain carbon credits will be by the end of the year. And we will wrap up the webinar with a Q&A section. I will now hand over to our CEO and founder, Guy, who will begin the presentation.
Thanks, Tanya, and good to see everybody again, although clearly I can't see you all. This is a really interesting time in the carbon market. There are a lot of changes and we have a lot of material to get through. I also wanted to just highlight some of the developments that we've uploaded onto the Trove Intelligence platform in the last quarter. And for those who aren't familiar with Trove Research, we have an extensive range of data and analytics to support corporate climate action on decarbonisation and the carbon market that serves it. We divide our services currently along 6 lines: corporate climate commitments, where we track up to 10,000 company climate action programs; carbon credit prices globally and nationally; voluntary carbon market forecast, so we have independent models that predict carbon or forecast carbon credit prices out to 2050. A very extensive policy and guidance platform that tries to keep track of the hundreds of organizations trying to influence corporate climate action, an extensive database of projects and transactions, and a module that we launched in April, which is our carbon credit integrity assessment tool. And we've been very active in the last quarter. On the policy and guidance side of things, we have now got detailed country profiles of over 21 countries, and we'll be shortly issuing a risk and opportunity scoring system for that. And across those countries, we cover 85% of global carbon credit issuances. We also recently launched an alert service that keeps our clients up to date with the latest rules and regulations affecting international transactions of carbon credits. And also an Article 6 tracker, where we monitor all of the government-to-government agreements that support decarbonisation and adaptation around the world under the Paris Agreement. On the corporate commitment side, we've got an extensive database of company action, their emissions profiles, scope 1, 2, and 3, and their consumption and use of carbon credits, and that's now covering over 6,000 companies. On the carbon credit prices, the team, we now have project level credit prices is created through AI algorithms based on our collection of pricing data from across the market, both on exchange and over the counter, and that's available for over 4,000 projects. We also have futures price data from CME and ICE, and we track all of the auctions that are bringing new projects and new credits to market all the time. On the carbon market forecast side of things, we now have price forecasts for individual technologies as well as the overall market and sort of generic reduction and removal project types. And we'll be uploading our biochar price forecasts later in Q3. On the projects and transactions side, we now have data for over 14 registries, including Woodland Carbon Code and Peatland Code in the UK, and a range of other national registries. And our fire tracking service that monitors the potential risks of hazards, including fire, but also landslides and weather, to nature-based projects throughout the world, and the risk to buffer pools and carbon credit issuances from those projects. So that's live. And then finally, the launch of the credit integrity assessment tool, which we've covered in other webinars and other public communications. And then finally, we have a monthly update of the nature-based solutions market, so covering REDD+ and afforestation, reforestation, and we also do a quarterly webinar for clients to appraise them of those latest developments. So we've been incredibly busy. As well as a lot of things going on in the market, we continue to innovate and expand the range of data that we provide. So let's just take a step back. Why are we here? If anyone is listening from the tip of South Africa to the middle of Europe, it won't be a shock to realize that it's getting quite warm out there. And the science and the numbers coming in are quite alarming reading. The global daily air temperature is now out of bounds of all previous seasonal data to date. And if that wasn't alarming enough, the global ocean temperature deviation from historical averages is again nearly off the charts. And this is an El Nino year, so one would expect it to be greater than average. But even taking into account those El Nino years going back to 1979, what we're witnessing at the moment is still extreme and breaking records all over the world. This last year, the world was 1.26%, 2.6 degrees above pre-industrial baseline. And the expectation is the El Nino this year will bring us temporarily close to the 1.5 degree target that the scientists under IPCC have said we need to try and limit global warming to. The extreme heat has been observed not just in one region, but globally in Southern Europe, US, China, and Q3 up to 50 degrees centigrade. And we're getting to the limits of human habitability in the terms of wet bulb temperature in many parts of the world. Extensive fires in Canada, with smoke now traveling across the Atlantic as far as Europe. And what does it mean for the human population if 70,000 heat-related excess deaths were recorded in Europe in 2022 and is expected to be even more than this year? So it has a real impact on population as well as the natural environment. And the scientists say that with only 250 gigatons of CO2 left, or 6 years, we have at our disposal to try and make a serious downturn in global emissions. So that really is a call to action. And the rest of this presentation is to look at how the corporate world is voluntarily picking up the baton and trying to make progress. So let's start with some good news. There is no let up in firms realizing this challenge and taking climate change seriously. The increase in the number of companies signing up to science-based targets is accelerating. In Q2 this year, we had 532 companies adopting the 1.5 degree target under the science-based initiative. And we now have over 5,400 companies either having set targets or committing to set a target in the future. These are all future targets. They occur in the interim, so up to 2030, 2035, and then beyond up to 2050. And in fact, of the companies that have set or have committed to 1.5 degree near-term targets, 730 of those and 119 new ones in Q2 have also committed to the SBTi's net zero standard, so the 2050 period target, which will require them to net off their emissions for in addition to any residual emissions that are left after their abatement has taken place. And interestingly, the these are large companies involved in this in making these commitments: Vattenfall, Enel, EDP, all in the energy sector. Lenovo in the computer world, Uber, cement, FMCG companies as well. So there's some really big names there, and the world will be watching to see whether those targets and those commitments can be fulfilled. So that's good news. The that activity is also spawning continued investment in project activity, and this is our tracker of the pipeline. So the potential issuance of projects that have yet to be registered on all of the main registries and standards. And you can see we're up to about 744 million tons of CO2 equivalent issued per year from all of those projects, and that pipeline has been accelerating. It's up 130% from where it was 12 months ago, and has increased 14% from Q1 this year. And you can see in this chart the big pink sort of wedge in the middle, which is in this classification system is a high level term called energy efficiency. A lot of that are cook stoves, and there are I think 700 cook stove projects that form a large part of that increase, and they do a lot of good. We did a separate webinar on that. They do a lot of good in Africa and other developing parts of the world. So that call to action from that I mentioned before is being responded to in certain ways, particularly in anticipation of those corporates needing to claim some of those credits, and that's what we'll get onto in the rest of this presentation. That pipeline hasn't yet translated through to the sort of potential for issuances of carbon credits. This is the issuance to date up to the end of Q2. We were up 83 million tons in Q2 compared to 74 million tons in Q1. In the first half of this year, 170 million tons compared to 165 in the same first half of in the first half of 2022. That's just a 5% drop. One of the interesting patterns here is in Q1, the decline in RED Plus issuances, largely I think in response to the hiatus or concerns and attention applied to RED Plus and the integrity of some of those projects. But that seems to be bouncing back in Q2 with an increase in RED Plus issuances. But really sort of I think the overall picture in Q4, the extra green bar on the top is jurisdictional RED Plus, which we may see more of going forward, and Lucian and the team will be able to talk more about that potential under the Article 6 type arrangements. But excluding those jurisdictional REDs, we've sort of, the issuance is pretty much holding constant at sort of 80, 90 sort of million tons per quarter. How does that compare to the demand for carbon credits, the number of credits that are actually being taken out of the system and retired by corporates? That lags issuances. It has done since we started tracking this many years ago. In Q2, the retirements were down from 48 million tons to 37 million tons. Compared to over the first half of 2023, 85 million tons of retirements compares to 93 million tons in the first half of 2022, a fall of 9%. So retirements have fallen a bit faster than issuances. But if you were to read a lot of the media headlines, and we'll come on to that, I think that this is a moderate response and still shows a continued appetite for corporates to engage in this market in spite of some of the headwinds that that are out there. And again, looking at Q2, one of the interesting patterns is the reduction, from the 48 to the 37 is the reduction in the dark green bar, which is the RED Plus credit. So that sort of drop in issuances in Q1 has perhaps lagged a little bit and now is being reflected in the Q2 retirements. But renewable energy and the rest of the demand for the rest of those project types sort of remaining constant from Q1 to Q2. So that's sort of the state of play. What it means for the surplus in the market is, if you compare the left chart to the right chart, the surplus has increased as issuances exceed retirements in each quarter, and we're up to about 860 million tons of surplus. Now, will all of that is about 4 to 5 times current annual demand, but will all of that ever come to market? With increasing scrutiny on the whole market, and this is why one of the reasons why we launched our integrity assessment tool, which allows users to really differentiate between good, medium and poor quality credits, there is a reasonable chance that not all of that surplus will ever be bought, as buyers become increasingly aware of the provenance of a lot of those credits, and also the standards requiring greater disclosure of the source of those credits when claims and companies are retiring them. So quite a lot to digest there. I will hand over to Yelena, who'll give a little more color on the causes and reasons for some of those changes.
Thanks, Guy. So yeah, what's behind the 9% fall year to date in retirements? The big story has been a handful of very large corporate buyers reducing their use of carbon credits, in particular 3 airlines, Delta, EasyJet and JetBlue, and 2 consumer companies, Kering, which includes the luxury brand Gucci, and Nestlé, which have all announced in the last 3 to 9 months that they are reducing or stopping using credits, as we can see in the table on the slide right now. These 5 firms made up 16% of total retirements from 2020 to 2022, so their pullback explains a large part of the drop in year-to-date retirements. Now, if Delta Airlines alone had retired as many credits in first half of 23 as it did in first half of 22, the market drop in retirements would only be 4%, not 9%. Now, what's behind these firms' decisions? No doubt, the very public criticism of their use of carbon credits and related carbon neutrality claims played a part, with credit use potentially harming, not helping their brand. Financial pressure also likely played a role. However, in their public statements, all 5 of these firms try to emphasize that they are not pulling back from their environmental commitments, but instead changing the climate strategy to direct expenditure on investing in innovations such as sustainable aviation fuels. Now, looking elsewhere at corporate activity, in the voluntary carbon market, a more mixed picture emerges. At Trove, we have the world's largest database of corporate credit usage, and we know that almost 200 companies have disclosed they are using credits for the first time this year, up from 126 in first half of 22, as we can see on the grey box on the right-hand side of the slide. While these new companies only represent 4% of year-to-date retirements, new entrants to the voluntary carbon market will be welcomed by those who support the growth of the voluntary carbon market. Now, the public criticism I just mentioned has led to a discussion around whether some corporates are now trying to keep quiet about their action on the climate, so-called green hashing. However, within the voluntary carbon market, we have not seen any real hash to green hash. Publicly disclosing which company is retiring a credit is not mandatory at most registries. While it fluctuates month by month, over the last 3.5 years, around 40 to 45% of retirees have been disclosed across 10 of the world's largest registries. There has been no evident or sustained change in disclosure rates this calendar year, despite the pickup in public criticism of carbon credits. We've also seen no distinct or sustained trend in the quality of carbon credits retired. Trove has uniquely assessed the integrity of over 4,000 carbon projects, allowing us to analyze in depth for the first time market-wide changes in the integrity of corporate credit use. Positively, there has been a persistent but very slow drop in the use of the lowest quality credits in the market. And whilst their share is almost too small to see in green on the left-hand side chart, the use of very highest integrity credits has doubled in volume every year since 2019. But overall, corporates are still using a mixed quality of carbon credit. Hopefully, new emerging quality standards plus new private sector products, such as Trove's Carbon Credit Integrity Assessment Tool, will allow corporates to increase over time the quality of credit they are using. Another interesting trend that we've seen is a trend towards slightly older credits being retired, as shown in the chart on the right. Although at 2017, the average vintage retired remains similar to last year. It's too early to conclude what's driving this, but given older vintages typically trade at a lower price, so squeezed corporate budgets might be driving corporates towards slightly older credit. This demonstrates that, like any other market, corporates face ongoing trade-offs between quality and price. My colleague Gregoire will talk more about market prices shortly. Before that, though, there is one other major corporate demand trend from the last quarter to highlight, and that is the growing market for purchases and pre-purchases of high permanence engineer removals have been announced this half of 2023. In total, 3.8 million tons of purchases have been announced so far in 2023, already 46% more than in the whole of 2022, and a remarkable 38 times more than 2021. Some of these deals that hit the headlines included Microsoft announcing an 11-year deal to buy 2.8 million of BECS removals from Ørsted, JP Morgan announcing 3 large removal contracts, including a 9-year direct air capture pre-purchase and a 5-year bio-oil carbon removal pre-purchase. NextGen, a joint venture between South Pole and Mitsubishi, to build a diversified portfolio of over 1 million removals by 2025. These investments in carbon removals are a real positive for those who hope that these technologies can quickly scale and thereby start to have a meaningful impact on the climate. We're not there yet, though, with actual tons removed remaining very small at just under 100,000 tons of CO2 so far in 2023. The prices of many of these trades have not been disclosed, but are likely in the range of $300 to $800 per ton, well above the cost of more traditional carbon credits, as my colleague Gregoire will now discuss. Over to you, Greg.
Thank you, Elena. Just to recap the past year and a half, credit prices rose quite strongly in the second half of 2021 until the start of the Ukraine war in Q1 2022, after which they fell consistently through the rest of 2022 and into early 2023 as macroeconomic challenges dominated the field. Now, in the first half of 2023, integrity concerns have compounded these broader challenges, which have weighted even more on market confidence and liquidity. And as you might know, in particular around nature-based credits. So as a result, average prices in the market in H1 2023 have averaged 13% below their level in the second half of 2022. That being said, the second quarter of 2023 has seen the market stabilize and recover somewhat. Prices have averaged 6% more in Q2 than they did in Q1 at 6.6 USD. Partly thanks to steady sales of credits from higher priced mangrove restoration projects, or chemical or ozone depleting substance reduction projects. And note that this overall market price is public as of today, so feel free to use it to monitor changes in the future. Now, average prices only tell you so much, and in fact, volatility remains high with monthly average prices ranging from $5 to $8. And with pretty highly heterogeneous prices across different types of credits. Trove produces over 30 credit price indices on a weekly basis. So on this slide, you can see how our five main project types have evolved. The biggest story is around Red Plus credits, of course, where integrity concerns have led to price falls, down 17% on average during Q2. With Red Plus prices now trading at similar levels to other reduction types at around $6.5. and as of the past 2 weeks, their lowest point in years. The price of renewable energy credits, which is the most voluminous project type, has been steadier in Q2, averaging just 3% less on average in Q1, although here too the price did dip in late June and in recent weeks. Energy efficiency also decreased, down 25% average during Q2, and that's despite a renewed interest in clean cooking. But in contrast, non-CO2 gases credits went in the opposite direction, with some pretty high price trades in North America boosting the average price. And to conclude, nature restoration prices broke out of their previous low and have increased by an impressive 63% thanks to some high-priced blue carbon sales. But however, please note that volumes in this specific project subtypes remain very light, and hence they're particularly vulnerable to a handful of large trades. So there is no telling how the aggregate average will evolve. And on to Lucian for major policy developments.
Thanks, Gregoire, and thanks to everyone for joining today. So to round off first our view of trends in the market, market supply and demand, but in this case related to policy, we wanted to highlight the continued interest from countries in signing bilateral agreements to transfer emissions reductions under Article 6.2 of the Paris Agreement. And as we can see here, there is growing momentum so far into 2023. With more agreements announced in the first half of the year compared to the first half of 2022. And we again expect to see another flurry of announcements in the run-up to COP. And this is also a good moment to highlight what Guy mentioned previously, that we have launched this week our Article 6.2 tracker on Trove Intelligence for subscribers to provide detailed data on each of these agreements as they're announced, classified and categorized by the type of agreements as we show here. But to move on to the other key topics in the policy and guidance landscape over the past quarter, there have been a number of major developments, especially towards the back end of the period. And while the biggest story of the year so far may be related to carbon credit quality and carbon neutral cranes, there have also been a number of important steps forward. And so we wanted to look at these quickly now through the lens of our now famous headwinds, tailwinds, and crosswinds. The first one we wanted to highlight here is the launch of the International Sustainability Standards Board's Climate Disclosure Standard. We see this as a positive step, and many jurisdictions have already indicated that they're ready and willing to implement these standards. Next, with the SBTI's the Science-Based Targets Initiative's draft of its net zero standard for financial institutions coming out for consultations, we also see this as a major positive. This will be the first protocol that will allow investors and other financial institutions to set externally validated net zero commitments and reduction targets. On removals, we see this as a crosswind. We see that there are necessary debates going on around the roles of different types of removals in the Article 6.4 mechanism, under the Paris Agreement, in the EU's removals directives, and through the UK's emissions trading schemes. But this creates an ongoing uncertainty about what the roles and positions of different types of removal credits will be. On jurisdictional RED+, we saw the announcement of an agreement between the state of Tocantins in Brazil and the Swiss energy company Mercuria to provide upfront funding for Tocantins to develop its art trees credits. We see this again as a positive development. This approach could help unlock a sticking point for many jurisdictions, both subnational and national, in developing their jurisdictional RED+ programs by unlocking that funding to develop the programs, conduct monitoring, and meet art trees criteria. However, we also see, when it comes to jurisdictions, countries looking to take increasing oversight or even place restrictions on credits or influence revenue sharing agreements at the government level. The most prominent examples of this this quarter have most likely been Zimbabwe and Kenya, but also Zambia is announced that it is considering these measures too. This is certainly a headwind, not just because of the impact potentially in these countries, but also the uncertainty about how many other countries will follow suit. And just to note, this is one of the important criteria that we analyze in our country research on the Trove Intelligence platform, and also it will be one of the indicators, one of the criteria that will be part of our country policy opportunity and risk assessment tool that will be launching very soon. However, the criticism and scrutiny of carbon credit quality and the associated corporate claims in the media, from regulators and even in courts is certainly the most major topic of the quarter, and one that we want to dive into more deeply for the rest of the webinar. And when we look at the landscape of what's happened so far this year, it's understandable why this is the biggest story around. There are many different ways in which this debate has come to the surface. To start with, in the popular press, there's been a lot of high-profile reporting throughout the year so far, starting off with the Guardian's reporting on REDD+ project, but following through into reporting on benefit sharings and other issues around projects in Zimbabwe and other scrutiny of carbon neutral claims based on credits. With advertising regulators, particularly the UK's Advertising Standards Agency has started to issue rulings and crack down on misleading corporate claims that don't provide enough context or information about the environmental impact of that claim as it relates to the business as a whole. And we're also seeing other regulators elsewhere looking to take a greater oversight of advertising claims. On financial regulators, we see that they will increasingly require the disclosure of carbon credits in filings, but also take a greater oversight over the trading of credits. And we've even seen these issues arising in the courts. For example, with the decision in the Netherlands against the airline KLM for breaching EU consumer law about its carbon neutral claims, and the high-profile case brought against Delta based on claims that they're making, but also more specifically, the credits that those are based on. And so we'll be tracking closely whether these cases are upheld, and what the rulings are, and what the impact might be. And finally, there's continuing scrutiny from researchers. A prominent example being the research from Berkeley on the quantification of credits from cook stoves. But also this research is providing greater insight on how companies are making decisions around credit purchases, highlighting the need for continued corporate due diligence. And so to sum up these developments, we want to take a look now at sort of what these the main lines of criticism are, but also what are the initiatives that are currently ongoing that will help the market to respond. The first of these being the questions around the carbon impact, the carbon quantification of credits. And in response, we see that registries are continuing to improve their methodologies, to launch new methodologies for different types of emission reduction activities. And a major step forward, we hope, for developing a benchmark on credit quality and understanding of that across the market will be the ICVCM's core carbon principles, which will release soon. We should also note here that there is continuing private sector innovation, not just around analysing and tracking integrity issues, as we have here at Trove with our own integrity assessment tool, but also increasing use of digital technologies within the whole credit quantification process. And secondly, we're seeing that there is a discomfort around the carbon neutral and offsetting language, and it was in fact a lack of understanding around carbon neutrality as a term and its potential to mislead was a factor cited by both the UK Advertising Standards Authority and the European Commission in proposing greater regulation of corporate environmental claims. And so from this, it's potentially unclear what the future is for carbon neutral claims. But as a response, we see that new claim standards with different language are being developed, which we'll dig into a little bit more later. And finally, there has been concern expressed since the start of the year, since the release of the Guardian's article on tropical forest credits, that the credit usage delays corporate emissions reductions by diverting attention away from internal emission reductions. And on that, I just wanted to highlight here some of Trove's recent research that highlighted that on average, so on average, this is the median figures we're seeing here, that companies that have been material users of carbon credits in the last 6 years, on average have decarbonized twice as fast as those that have not made material purchases, have not used credits. This is a recent report we launched, and if you want to learn more about this study, you can download the full report for free on our website. But as I said, the key response that we want to focus on now for the rest of the webinar is the development of new claim standards and new claims guidance for companies. And in the first step we wanted to take to do that is to try and think about, well, what are some of the main criteria that we can consider to think about what a good claim standard or good guidance for companies need to do. And here we've come up with 5 proposed criteria. The first being that it should provide an incentive for companies to take action now. And that action should deliver an immediate and significant environmental benefit, both in terms of its own company's own actions and the wider contributions to global climate action and mitigation. The standard and its criteria should drive up corporate ambition, but should be wary of making sure that there are ways in, that there are things that are achievable for countries that are getting started on their climate journey now or maybe further back. And finally, when doing all of this, claims guidance should strive for clarity and simplicity in terms of how the criteria are laid out, but also how they're communicated, given the concerns about the potential for confusion or amongst the wider public about environmental claims. And consistency with other standards and regulations will be important for generating a broad consensus and understanding around credit integrity issues. And so what we want to do now is have a quick look at some of these claim standards, the existing ones and those in development, thinking across these broad areas of what a good standard might look like. And the first area we wanted to look at on that is claim names. And we can see on the existing standards within the voluntary markets, there is a focus on carbon neutrality language. But now in the new generation of standards and guidance that's emerging, we're seeing alternative ways to describe corporate contributions to climate action and corporate progress on climate, with, for example, the Voluntary Carbon Market Integrity Initiative's Silver, Gold, Platinum tiers. Gold Standard has proposed guidance for companies on how they can show they're fairly contributing to global net zero. And South Pole recently published a proposal for how companies can generate claims and can demonstrate that they are funding climate action, both in terms of their own actions and in terms of buying credits. And when it comes to government standards, we see that maybe the carbon neutral language will be permitted by these regulations, but with a significantly higher bar in terms of proving to regulators the evidence behind those claims. And so secondly, the next area we wanted to look at in terms of understanding these claims is based on those concerns about whether credits take away from corporate ambition is, do the claims require companies to first reduce emissions before using credits, and do they require companies to commit to net zero? And we can see here that this is a broad requirement under a lot of standards, but really in the standards that are emerging and being developed, we're seeing a higher bar for this in terms of the emissions reductions that the companies have to achieve in order to make these claims under the VCMI standard or the gold standards guidance, because these are about committing to net zero, which means a specific reduction pathway. And finally, on scope of emissions, we're seeing this as a broad requirement across all standards, but this perhaps going further to make sure it covers all scope 3 emissions so that you are net zero aligned. And finally, when it comes to credit quality, as we compare the standards, we see that having a criteria for the minimum threshold for credit quality has been a requirement within the market for some time, but what we're seeing now is perhaps this is going to be set at a higher bar, although in some cases it's difficult to know what that level of quality is going to be yet, but hopefully the ICVCM's core carbon principles will help set a threshold for this within the market. And third-party verification, I think, will increasingly become important to make sure that these claims are robust and trustworthy. And so across all these areas, we can see the VCMI stands out on these criteria in terms of aligning with those things that we thought could be good criteria for a good claim standard. And so because of this, and because of its recent launch at the end of the quarter, we want to spend some time exploring it in a bit more detail. And so in order to do that, I'll hand you over to my colleague, Delphine.
Thanks, Lucian. As Lucian says, a year on from releasing its provisional claims code of practice after a consultation, the VCMI has published its finalised claim code at the end of June, which aims to help companies make credible claims on their voluntary use of carbon credits. I'm sure many of you will be familiar with this, but just a quick summary for those who aren't. There'll be 4 steps to making a claim. First, companies must meet a foundational criteria. These are not simple formalities, but require real commitment to climate action. Companies must disclose their emissions, including Scope 3, and set a near-term science-based reduction targets and long-term net zero target also. Companies must not only set targets, but also demonstrate they are on track to meet their targets by reducing their emissions each year. Unlike in the bronze tier of the provisional code, there is currently no option for off-track companies to temporarily fill their deficit by using carbon credits. The VCMI is looking to develop additional claims tiers to provide an on-ramp towards the new tiers by November, which may include something similar to the bronze tier in the provisional code. Once on track, companies need to then decide what volume of credits they wish to use. Only if they retire credits equal to 100% of their full emissions can they achieve platinum status. Carbon credit purchases must be aligned with the ICVCM's core carbon principles. However, as many of us are aware, the CCP labels have not yet been implemented. Companies may use CORSIA eligibility requirements in the interim. Aligning credit standards with ICVCM and CORSIA is a positive step for generating consensus on credit integrity issues. On step 4, all credit use must be verified by a third party and disclosed publicly, something we saw in Yelena's analysis earlier. Only roughly 2/3 of companies currently do. Now let's have a look at whether it's achievable. Trove analysis of 500 companies that use carbon credits found that only 3.8% of them would meet the silver tier. Encompassing all companies that have made climate commitments, action is even weaker. Of all the firms with climate targets, only 8% have SBTI net zero targets. Of these companies that have SBTI net zero targets and report sufficient data to track their decarbonisation efforts, only 45% are currently on track to reducing their emissions in line with 1.5-degree goal of the Paris Agreement. This begs the question as to whether companies need to increase their ambition. Overall, the VCMI claims code is a really good step in the right direction. The code provides further guidance for the market, setting a high bar for corporate claims and reinforcing the need for climate action. The foundational criteria are strongly aligned with other high-profile corporate climate initiatives, and those who already engage in these initiatives may not need to make significant changes to align. However, some questions remain. Companies such as small and medium-sized enterprises and those in developing countries may lack the capacity to meet all requirements of the foundational criteria. We'll be interested to see how this terminology is adopted and also how further engagement can be rewarded. The additional claim tiers that may be released in November could provide a pathway to ensure all companies can engage in the code. Given the current scrutiny in the market, it is important to encourage companies to keep taking action in the interim. Some details are yet to be finalised, such as the monitoring, reporting and assurance framework, which is required for step 4 of making a claim. Now let's take a quick look at what's on the horizon for the second half of the year in terms of policy developments. The ICVCM will publish their core carbon principles criteria for assessing credit types next week. This will cover critical integrity issues such as additionality and permanence. Labelling of these credits are expected to occur in Q3 2023, which may mean that it's possible to start using CCP labelled credits in late 2023. Verra will release its consolidated RED methodology with the aim of improving how RED Plus projects can calculate their emissions baselines through assessing deforestation at the jurisdictional level. The Science-Based Targets Beyond Value Chain Mitigation paper will give guidance to companies that have SBTI targets on what they do beyond their value chain emissions reductions. The current draft is exploring other methods of BCM that don't just involve carbon credits. This is the first time the SBTI will take a position on mitigation that doesn't only cover value chain emissions. On Article 6, there are several meetings of UN bodies before COP28 in December, such as the Article 6.4 supervisory body. We will be keeping a close eye on the progress in the interim. Over to you, Guy.
Sorry, I was on mute. Thanks, Delphine. Thumbs up if you can hear me. Can you hear me? Yes? Good. As has been eloquently summarized by my colleagues, there's a lot of change happening. Companies have, in some situations, paused for thought, for good reason. But I just wanted to sort of finalize this presentation with a call to action and put forward the view that this sort of pause for clarification should not be a reason for companies to pause their climate commitments. their mitigation activity or their engagement with the carbon market. A lot of the criticisms that have been discussed are around the use of language. And there are easy ways to get around that. Just be cautious and conservative when making claims. Don't claim something that cannot be substantiated. Be specific and avoid generic claims. Be transparent, so disclose the source. And do your homework on identifying what a good quality credit is. These are all achievable and they're all doable. Certainly look to have claims and the sources of credit certified using the highest quality standards, and really sort of a final point, let's not use this as an excuse to delay action. The first slide we presented on the state of the climate is an imperative to act. So that is our final sort of parting comment. There is a huge amount of activity going on with the NGO community to try and clarify and bring forward rules and guidance that make sense and are really good benchmarks for companies to aspire to. So on that note, we are going to move into our regular audience poll of what you think the market is going to do between now and the end of the year. Tanya.
Hi, everyone. I'm excited to kick off the quarterly tradition we do where we ask you all your opinions on what you think the pricing of carbon credits will be by the end of the year. You should now see a poll pop up on your screens where you'll be able to answer what you think the price of renewable energy credits, clean cooking credits, REDD+, and nature restoration credits will be by the end of the year. Please go ahead and answer those now.
There is a scroll bar on the right-hand side. So the first window, the top of the window is the renewable energy credit question. But if you scroll down, the second question is clean cooking, the third is REDD+, and the fourth is nature restoration. Those are relatively broad categories. We acknowledge that, and there's a lot of projects which fall into those, but clearly in the spirit of efficiency and timeliness, we couldn't ask too many questions and break it out too far. So we are being pretty general here, but we do have history to go back to, and it will be interesting to see how the audience thinks today compared to how it thought at the end of the last quarter.
We'll just give you another minute or so to get those answers in.
And as Tanya said, the whole webinar slides will be downloadable from the website after the event. Tanya, how long does it normally take us to clean it up and present it?
Should just take another minute or so. You should be able to see the results on your screens now, and our team behind the scenes will be diligently presenting this to you very shortly.
Do you want to throw a question? Do you want to do a question while the tech team are compiling the results?
Sure. So, Guy, I have a question that I think is best placed for you. What do you think the impact of countries' export restrictions and/or taxes will be on the market? Do you think we'll see more countries imposing high taxes or restrictions?
Right. Okay. It's very topical. I think we saw today Tanzania. Was it Tanzania that is looking to? Oh no, there was a reaction against some imposition of export controls and taxes in some countries in Africa. It's been very fashionable or in vogue at the moment. I can see the logic of why governments feel that there is a sovereign interest in controlling the flow of capital towards natural or carbon reduction projects. I think that in the long run, that is perhaps an unhelpful intervention. In a free market, capital needs to flow to where the costs of the projects are best and most efficient to deliver. And any controls on on the flow of that capital could hinder that process. So I wonder whether there will be a backlash in some countries against that, because the project developers on the ground trying to do the good work will find less money flowing to them. And it starts to sort of look more like an Article 6 transaction being financed by the private sector, where the government say, look, we can deploy this capital. If that capital is ring-fenced for investment in carbon reduction projects, then that looks like an Article 6 project. Of course, those governments could take that revenue and not use it for mitigation activities or adaptation activities. They could use it for other purposes. So there's always a risk that that money will not flow to the projects where it was intended. And it's the theory, it's the theory of open markets that I think is at stake here. Lucia, do you have, being our head of policy, do you have any sort of additional comments on that particular question?
Yeah, thanks, Guy. I think one piece of context that I think is interesting to consider with this is, at least in terms of the justification for some of these controls, is governments are saying we're seeing benefit sharing agreements being made with local communities that maybe they didn't have full awareness of, full free, prior and informed consent, or maybe the terms of these benefit sharing agreements for local communities aren't particularly favourable. So I think one of the things is that in other countries where such predictions haven't been proposed yet, then making sure that agreements with local communities, stakeholder engagement are all done in ways that fit with the kind of the best practice out there, I think could perhaps be one way in which governments can be their concerns about whether these agreements are fair can be assuaged, or at least the scale of some of these government revenue offtakes, revenue sharings that could be reduced in size in other cases, because certainly that's been expressed, at least one of the concerns has been expressed by governments about why they're looking to do this.
I'm just looking to my tech team to see whether the results of the poll are visible yet. I can see one chart. Are the others up there? Let me just have a look.
I think we should be good to go very shortly. You can start discussing the first couple charts there.
Okay, hold on. I think they're just trying to upload the other two. So good. So we have the renewable energy results in, and that's a slight skew now that in the current economic climate, renewable energy, as Gregoire showed, renewable energy credits are already the sort of the lowest price credits available on the market, and the $3 to $6 category has bumped up from what looked to be like 53% of the responses to over sort of like 57%. So the market being a bit more pessimistic on that lower price range being being the most dominant sort of category of prices. Some optimistic ones being in the 26, above $20. And this does cover a multitude of project types. There's traditional wind and solar, which have been around for a while, but could also include sort of bioenergy type projects with perhaps with or without CCS, and off-grid solar, which have much higher cost structures. So there is no sort of one size fits all for this. This is a very generalized category, but you can see the skew to the left generally in this broad category. Looking 75% of respondents thinking that prices are going to be under $10, 55-56% thinking they will be in the $3 to $6 range. For clean cooking, again, this is a really interesting profile, because it seems to be that the whole market, we have 580 people responding to this, that the market, in spite of the headwinds that we've been talking about, hasn't really changed its view on clean cooking from Q1 this year when we last ran this poll. So the median price being in sort of the 7 to 10 or 7, probably around $10 for clean cooking, which is, as I said, not that far removed. That profile really hasn't shifted much. since the end of last year when we first did this year's one in January, when we looked back over 2022, and then in April and today, these profiles were this for clean cooking anyway. It really hasn't changed that much. So I think that's a really interesting observation. For Red Plus, well, given what we've seen and what Gregoire showed on the pricing index that we track, there has been a shift down to the left-hand side of this curve, the $3 to $6 range, now counting for 30% of poll responses compared to in January of this year when it was about 5%. So there's a much more pessimistic view on project-based red. There are some people out there who responded who think it could go up to $26. Again, there is there's a multitude of different project types, so we are being very general here in this emissions profile. But compared to January of this year for Red Plus, where the most most likely price range was $11 to $14 at just over 40% of respondents, we're now the market is a lot more pessimistic on Red Plus. Probably the volume weighted average here, or the weighted average of responses, would be in the $7 to $10 rather than the $11 to $14. Excuse me. And then for nature restoration, again, really interesting, a skew to the right of this curve, where the majority of respondents are seeing, so across 15 to 18, 19 to 22, 23 to 26, about over 20% of respondents. So 70% of the respondents, of the 500 respondents on this survey, believe that the price for nature restoration by the end of the year, as a very broad category, will be above $15 a ton, and probably a weighted average around $20. So those are really, I think, interesting findings. The wisdom of the crowd is always quite a powerful indicator. Not perfect, crowds get things wrong, but it's a very interesting shift. Do we want to then go back we're nearly on time. I think we've got 2 minutes left. Is there one more question we can take, or should we, Tanya?
Yes, I have a couple more questions if we have room for it. But of course, if you all need to drop off on the hour, that is completely okay. And the recordings will be posted tomorrow. So I have another question for Lucian. Lucian, what is the Trove view on the outlook for Red Plus?
Great, yeah, thanks Tanya for that question. Thanks to the audience as well. Thanks for everyone for joining in case they have to drop. Well, I think we see that jurisdictional Red Plus is not going away. I think jurisdictional Red Plus is going to become a very important part of the market, but obviously it's a big shift away from how projects are run, and so therefore it's going to take time for these programs to be put in place and for the arrangements to get these to market to come together. But we see that there is interest from the tropical forest states and countries in delivering this, and there is interest in buying them, given the perspective in the market that jurisdictional Red Plus is high quality. So there will have to be a way in which the jurisdictional programs and project-based red can coexist. And when we think about nesting project baselines within the baselines of the jurisdictions, this can also be a way that can improve the quality and the trust in the carbon accounting around Red Plus projects. So I think jurisdictional Red Plus and nested projects is probably the long-term future for Red Plus that we see.
Thank you so much for that answer, Lucian. I will direct the final question of the evening to Yelena. Do we think some of the companies who have stopped using credits come back to the carbon market at some point?
Hi, thank you, Tanya. Can you hear me okay? I apologize again for my previous sound issues. Is everything okay now?
Yeah.
Okay, cool. Thank you. Okay, will these companies that are pulling back now potentially come back? If I initially focus on the airline industry, we would say they potentially could, and why would that be? And I would say that one, if they want to grow the business and they will be part of Corsia, they will need to neutralize their growth under Corsia. And also, we also think that the other technologies that are currently invested to decarbonize potentially will be very expensive. We all want sustainable aviation fuels and aircraft efficiency and etc. to be scalable in the near and long term. But if that is not will not be possible, then airlines probably will come back into the voluntary carbon market. Looking into other industry or other sectors, yes, potentially hard to abate companies in the hard to abate sectors will probably need to neutralize, and especially if they're committed to the SBTi science-based targets. And in terms of other claims, so not using anymore the carbon neutrality, but like other forms of claims which will be profitable for businesses, then we also see corporates coming back to that potentially are pulling out due to the reasons that I said during the presentation, coming back into the carbon credits usage.
Great.
Thank you so much, Elena, for your answer. I'll pass on to Guy for some final words.
Well, that was it, really. Thank you all for attending. We've just run over a few minutes. Apologies for that. Thank you for listening. I hope this has been instructive, and please get in contact if we can answer any more questions and help you with your carbon journey. We look forward to being in touch and talking to you again soon. Have a good day.
Thank you all for joining us today, and we greatly would appreciate your feedback. There will be a survey that will open in your browser after this webinar. Please take the time to answer it if you can. And as a reminder, the recording of this webinar will be posted on our website tomorrow. Please feel free to share this with your colleagues, and follow us on LinkedIn, Twitter, and Instagram at Trove Research for updates on our future webinars and future endeavors. Thank you so much, everyone.